Well, good afternoon, everybody. Thrilled to be with you as always. And we're talking about one of my favorite topics today, and that's how to hit weekly options, potential doublers on very fast moving stocks. So we call them McPwng stocks, which is not quite a FANG acronym, but it's essentially the six stocks that we found work the best. And they're not household names per se. So I think you're going to be really interested to get some fresh material here on some names, but it's still having a tight focus list so you can zero in on and get real-time trade alerts in and out when you need to buy, and more importantly, when you need to get out. A reminder that everything that I share with you here today is for your information and education only. Nothing that we talk about here should be considered a specific recommendation to buy or sell any particular investment. Of course, you know that you are 100% responsible for your own investment decisions. Big Trends and its team are not responsible for any trades you choose to make, and not all products from Big Trends are going to be appropriate for all types of traders and investors. Every trade you do, as was alluded to, involves risk. And so we want to talk about how we manage that risk as we go through this presentation here. Reminder, we don't provide personalized financial, tax, or legal advice to any individual. What we do is we take our research on these weekly options trades, we fire them out through real-time email, real-time text alerts to your smartphone when you become a subscriber, and then you decide how you want to best implement that. Do consult your tax advisor too before you do anything that's going to impact your unique tax situation. So what are these unique stocks? Those are the first initials of the six names that we use. Didn't have many vowels to work with. Pat, can I buy a vowel? But bottom line is that what we're after here is that they're the best ones to use. They're the weekly options names, which means that we're in and out in a matter of usually 2 or 3 sessions on an option that might last for a week to 10 days. So you think, wow, that sounds like you're getting really close to the end of the expiration, but we're in and out so fast before the expiration. We never take anything to expiration. We'll talk about how, and the selection of the option is so important, and that can generate some really tremendous winners. When we get a double, we tend to say that's good enough for us in 2 or 3 sessions. We'll take it. That doesn't happen all the time, but it doesn't have to for you to come out really far ahead. You probably heard of the 80-20 rule in a lot of aspects of life, the Pareto's principle. We're going to talk about it in trading. And I'm going to give you a very specific indicator setup that you can use, so you can take home, and after all these great talks today, you can say, let me start applying this and looking at this and seeing on any time frame how you can start really truly seeing the trending phase for a stock and leaving the chop or the range or the uncertain phase alone. And we're giving you loads of case studies here too to help you model success. Now, what are these McPwing stocks? I don't know exactly how to say that still, but bottom line is that the M is for Macy's. And Macy's is not the first name that I would think of when I'm talking about trading a really good momentum name up and down, and yet it's one of the best performers in our long-term look back history and our forward testing and real world trading as well. So and we get retail exposure that way. Everybody threw Macy's out as a dead stock a few years ago. Then it came roaring back, and now it's basically one that we like to trade both ways. Canopy growth, when you think if Macy's is kind of too old school, Canopy growth is new school in the form of cannabis. You're talking about exposure to the marijuana sector, which is something that maybe some people may not be into, but the bottom line is, whether you're into it or not, this stock is something you should be into because it moves a lot, and so you can really take advantage of it. I like it better than some of the other household names that are becoming more household, and so Canopy's our favorite in that sector. PayPal in credit card processing, there's probably some multiple themes that we're going through here, although maybe Weight Watchers doesn't quite go with Canopy growth too well, but maybe you need Weight Watchers after the Canopy growth part of it. Anyway, it's been a full day here. Bottom line is Weight Watchers is a great trending stock ever since Oprah's involvement as a majority shareholder, and so that's something we'll look at. NVIDIA is probably the most household name you've heard of as the chip leader in all the artificial intelligence or AI applications. And bottom line is it's got tons of opportunity on both directions. Probably the name that's the least known of these is Canada Goose, and yet it's the one that we just achieved in the past week, and they're doubler on, and we went ahead and took a 90+% gain out. I'll share that with you a little bit later. But the whole point of this is that when you start adding up these kind of what we call micro diversification, we're not going into household names. We're not just saying you want some industrials, you want some banks or financials, you want some healthcare or big drug stock. This is going a little deeper into really the new age growth areas. We talked about AI with NVIDIA graphics. We talked about Weight Watchers in the health weight loss category. PayPal is kind of the newest in the payment processing group to really take off. And then, of course, a couple of retail names with Macy's and Canada Goose, along with the new age cannabis play. So the beauty of this is that we can take bull and bear opportunities, and we didn't try to just create this just to create something far out. We try to say, look, let's go and see what the data tells us. And the data tells us that when we can trade these names, we can actually be in less correlated areas. We don't just have a bunch of tech stocks, which, we trade the FANG stocks too, but you're basically trading a whole lot of tech or new age tech when you're trading the big FANG names. And this is really, I think, a more diversified approach. And the results is what we're very encouraged by. Now, we know that past performance doesn't guarantee future results, but this shows that if you put never more than $1,000 into any one of these weekly options trades that our system triggered since the beginning of 2018, so now we've had about 15 months, no trades yet in April that have been closed. But bottom line is that we'd be up $6,768 in gross profits, adding up all the gains and losses before commissions. Now, we would say that if you're paying too much for your option commissions, you should definitely check with us at Big Trends, and we can walk you through brokers and get you in and out very, very effectively. One of the things you'll note too is that we like to win bigger, and we like to usually try to lose smaller. And you can see that when you look back over the last year and a quarter, that you have certain months like January of 18. A lot of people did well in January last year and then gave it all back in February. We made money in both of those months. Sure, we gave a little back in April, then we quickly made it back May and June. And then our kind of lone really big outlier losing month there was July last year. You see that you go through a few months where you're tempted to give up. This is what I always tell people. If you go through a little drawdown phase where you're giving back some money in a trend following system, you'll often give up right before you get to the big gain month that more than eclipses what you just gave back in total. So if you gave up about, in this case, $1,270, and then you made $1,735, assuming you can stick with it, that's the goal. The key is we want to keep our losses small, let our winners run. You see, so far this year, up a few percent, maybe about 4% on a portfolio basis. That's about 4.5%. Not a home run yet, but bottom line is that no, we can keep the losses small, let the winners run. Here's an example with Weight Watchers. And here's a couple things. We're going to look at what all this means here, but the line I want you to look at through this whole thing here is that green line here, and this is called the ADX. That green line is something that we want to see that going up, up, up from a relatively low level. So it's not just getting a signal on ADX, but it's also saying, you know what, we want to also make sure that we can stay with it so that that signal stays in motion. So a lot of times you'll see people that they'll catch maybe a first phase of a move. We got our bear signal here right at the close when it's about $31, and we recommended buying a 35 strike put. That means if you're new to options and put options in particular, sometimes confuse newer traders, that a put is a right to sell the stock at, in this case, at $35. When we're already at 31, it's already worth intrinsically $4 or $400 per option contract. So the thing is that we're trading in the money options with this approach, and that gives us the ability to leverage it on relatively small moves. You see it drop down to just under $29, and we're making 100% for about a 6% drop in the stock, maybe 7% drop in the stock. So you see the leverage potential here is pushing about 14 to 15 to 1. So if it keeps on going after that, that's fine. But we've learned that if you take a double in a couple days or 3 days trading wise, that's good enough to say book it and take the money and run. Kind of curious to get you involved here, what type of trader you are. Would you say you're more of a day or quick trader, 1 or 2 days as your typical in and out on an option trade? Swing trader, 3 to 5 days, hit the number 2. Position trader, hit the number 3, 1 to 4 weeks, or the active investor and passive investor categories. Great to see you, Jan, in there as a swing trader, Nick in there as position trading. We got a lot of swing traders, Gary, Albert, a lot of familiar names as well. Great to see you all, and a lot of new ones too. Jim, Mark, swing and position. So a lot of you are in that range. We're probably on this portfolio somewhere between the day to swing mode. We're probably in the 2 to 3 day typical. So we're about a 1.5 here, right in the middle of that. But the beauty of this is that you're going to see from what I show you that you can use this on pretty much any time frame. We just like to be a little quicker to make sure that not only we get in quickly when we get a signal, but that we can get out quickly when we need to. So that's where the speed of movement for us becomes very important. And if, by the way, if you're afraid of missing out on trades, you can also automatically trade this weekly options accelerator system I'm going to teach you about here today. More on that at the end of the presentation. We use a lot of platforms, TradeStation, Thinkorswim, Metastock. There's a lot of good ones out there. You could track ADX on average directional movement on pretty much every major platform out there. That ADX goes hand in hand with the DMI lines called the directional movement lines, and then the average true range concept. And this creates our trade funnel to really narrow this down. We do use a moving average filter as well. I'm trying to pack a whole lot into our presentation here so you can kind of really understand this better in addition to see all the case studies. Directional movement, the Wells Wilder, the same guy who invented the very well-known relative strength index RSI oscillator, his big contribution on this particular indicator is he said, you know what, a lot of people talk about the range as the high-low range for the day. And he said, if you get a gap from yesterday's close, say a big gap up today, you see it'll happen all the time, and then the stock just kind of chops in a tight range the rest of the session after the big gap open. He's saying you're missing the true range, which should include the amount of the gap from the prior day's close. So he started measuring those true ranges and saying, you know what, you're now seeing a lot more of the total real movement you're getting, including those gaps. And then the DMI lines are meant to show you, are you making net new highs? If you make higher highs, that means the DMI positive or DMI plus indicators going up. And if you're making higher lows, that means you're not getting the DMI minus negative new lows kicking in. You're actually getting more of an uptrending, higher highs, higher lows. You know what that looks like. That up channel is called an uptrend, right? This will help you define the trend phases. More importantly, ADX will help you to really zero in on the best configuration, in my opinion, which is when you start to get, say that, what I just showed you, said positive directional movements going up, you're getting net new highs. Negative directional movements going down, you're getting higher lows. Higher highs, higher lows, that means ADX is going to start ticking up because it's going to show you that you're getting a trend in motion. And Wilder created it as a percentage scale so you could compare apples to apples or apples to Facebooks or whatever you like to trade. Canopy growth is our first one we're going to talk about here. And so what we got a very specific pattern here. And let me just further explain what's all in this chart. The moving average here we show as the black line. And that's our just basic filter. The only thing that does is it prevents us from taking a trade against a longer moving average. So you see we are above the moving average. It's not the slope that counts. It's just where are we trading at a close against that moving average. So we're above it. We could not take any bear trades even if the bottom ADX and directional movement lines suggested we should. We would just pass on a trade if it's above that moving average unless it's a bull trade. You can see this one's a bull trade because the positive directional movement line in blue is making a big upsurge and a new high. Obviously, you can see why it's gapping up that next bar there, right off of the open. And these are, by the way, half-hour bars. So a 30-minute candle here says we wait till the end of that 30-minute period. If we're talking Wall Street time, this is 10 a.m. is our first 30-minute close every single trading day. And you say, okay, at that point, you see, gee, it's spiked up, but look, it closed down a little bit. Should that worry you? A lot of people would be like thinking, oh, that's a big loss of momentum. But our system's saying, you know what, ADX has been down. The negative directional movement's declining because you're not making any new lows. And the ADX, I'm just going to call it with an A here, the A is just crossing up above that declining directional movement ADX is in green right at the close of that first bar. So when we're coming from a low level and we're now crossing up on that ADX, that's often a tell, if you will, that tells you that, you know what, this has been stuck for a while. And you can see even before we got the gap up, this was just flatlining that prior day. So a lot of times you'll have gone through a consolidation, a little correction, or a little just chop, and then all of a sudden, so the ADX is non-trending, it's very low, and then boom, it starts to really tick up. Now you can see here in this particular case that there are times where price action might tell you, you know what, price action is starting to fade down here later that day before that day's close. A lot of traders would bail on that and say, uh-oh, momentum is turning. I know a lot of people that say you should only look at price action, indicators have too much lag. Well, if you only look at price action, I tend to tell people, here's your neck brace because you're going to need it for the whiplash that you're going to endure with just following price action alone. So ADX is showing us that, you know what, this is still going up. It's going up at a slower rate, that green line, but it's still going up. A lot of people might say, oh, the DMI plus line crossed down underneath here, right about there. Shouldn't we get out? As it turns out, it ended up being about the same level we got out right here the next day, but it did go higher first and had the chance to keep going. It's just that when it turned down that next morning, you can see we're getting an ADX rollover. That's our absolute last point that we would hold a trade. Now, in between, there are points at which we can hit what we call our trailing stop, which is basically saying that if we give back too much of our gains, once we've got a healthy gainer, then we basically will let our price stop kick in to protect our profits, to not give back all of our gain. That's another tool that we use to help manage the trade. So here's another bear case. This is PayPal. You can see PayPal has now moved below the moving average on the broader basis, and you see this was happening right here as we start to see this ADX turning up. And notice the trigger points happening as it crosses above whatever is the declining directional movement. In this case, the positive directional movement's going down, meaning you're not making any new highs here on PayPal. And we're recommending to 86 puts here when we're getting in the neighborhood of about 83 bucks or so. We're getting a 310 on those 86 puts. Now you notice we got the benefit of a gap in our favor the next morning. But even before that happened, notice that as there were some occasional little slow periods here, once you're in the trade, you're tempted sometimes when things look kind of slow, it's barely edging down and you're going, maybe that's lost its momentum, and it's saying no, it's just catching its breath before the next potential move in your favor. It doesn't always work that way, but you see when it gaps down at 77, this thing is going to be sitting pretty and ends up at a double that next day. Now, if you wait until the ADX does indeed turn the day after that, it's now gapping up and you're giving some of that game back. So those windfall gaps in your favor, when you can get a double or sometimes better, you say, thank you very much, I will take that money and run. And we teach RKS, what's the specific settings on the moving average? We teach all of the settings to all of our paid subscribers. Whatever term you subscribe for, you get a rule sheet so you can follow along at home and set up and configure based on what our testing shows to be the absolute best. Now, from this perspective, you say, when you're looking at what's this principle like, it's a lot like, should you buy a house or should you just rent it when you want to be, say, in Florida in February when it's sunny, while I'm in Kentucky and it's been cold and snowy in Kentucky, and just generally ready for some warm weather here. I'll pay a premium to rent that place down there for a couple of weeks or even a month to say, you know what, it's good to get that when you need that that exposure. Why would I buy that house and hold it the other 11 months of the year that I might not really want to be there when I can just rent it, even if I pay a little premium for it in a desirable time, and then I can leverage the rest of my capital and not tie up a bunch of capital that basically goes gets locked up those other 11 months of the year. Options is the same kind of principle. So it's saying, you know what, why would I buy NVIDIA shares, for example, and cost me 15 grand? Of course, some of the examples can cost even more, but that's one that's probably the highest dollar one among our big weekly options names that we like for this program. Say, you know what, I'm never going to pay more than $1,000. $10 a contract is $1,000 to control a $15,000 investment in 100 shares. So I'm saying, look, right away I've got a 15-to-1 leverage. Now, if I bought an option for say $5, I might have 30-to-1 leverage. But the idea here is that we're not trying to maximize leverage. What we're trying to do is maximize when we have the edge. So remember, leverage is a double-edged sword. I'm not claiming that leverage should be used all the time. It should only be used when you really have an edge. So a couple of cases with NVIDIA on the downside, you can see we would only consider the downside setups here. That's all we had, it turns out. But you can see we get that crossing point here, and you see we're getting our bear signal on NVIDIA, and here we're buying an in-the-money option. It's about, you can see the stock's trading about what, 148, 147 and a half, something like that. And 155 puts worth about $7 intrinsically. We're only paying $860. So if you think about it, you're paying an extra $160 out of your $860 is what we call the time portion of the trade. The intrinsic value is $700 of that $860. So really you're paying just under 20% of your total option premium is time risk, so that if you do see something where nothing happens, then you can really be in a situation where you really have a a really good leverage vehicle that doesn't involve so much time risk. People that buy at the money or out of the money options with these weekly options are asking for trouble in general. The only time we would probably do that is in something where it was even super high dollar, like some of the FANG names have become. And then we've got to be really, trading them very close to the vest, even shorter term, to make sure that that time erosion is not a factor. So we don't have to worry about that with this portfolio. We're keeping them in the money across all the big 6 names that we trade. Now that may result in a smaller profit. You see 27.9% on this one, but then the next one here we go again. Oh, by the way, where's our exit? We got our trailing stop exit, and see it starts to move in our favor, but then when it V's up against us right here, if we give back too much of our profit, we're going to get taken out of that trade on that green candle part way up because it's giving back too much. We want to see something that flattens out or keeps edging down, and so the trailing stop protected about half of our maximum gain here. In this case, now we're just waiting another couple of sessions here, and then you see it takes a few bars into that morning of the 19th of December, and then we get that signal. Now, sometimes when you get into a trade, have you ever had this happen? You get in a trade, and you're like, okay, I'm ready, let me go. It looks like it's going to break down, and then, it doesn't. It starts flattening out, and you start wondering, gee, did I just buy the low tick of the day? I don't worry about that anymore, because essentially all I'm doing is saying, let me watch the ADX. It either hits my initial kind of disaster stop, which is very unlikely to hit. More likely is that ADX, if it had rolled over like a down move in that green line there, then we would get out. But you see it flattens out, but it does not roll over, and then it starts dropping hard. So, it's almost like the market will tend to frustrate the majority of traders the majority of the time. So right about the time everybody thinks there's a breakdown, then it might flush some people out with a little counter trend reversal kind of move to make you question your trade, and then it'll go on to ultimately where it wants to go on. You can see in this case, we don't get a bend in the ADX until right here. It's the slightest bend, but it does make us get out of this trade here at a 55% gain that next trading session. Notice we generally prefer to try to hold trades a couple of sessions, but sometimes because of stop management or even profit targets, we might get out in the same day. We just don't want to do a lot of day trades so that smaller accounts can participate. Even if we do 2 or 3 day trades in a week, we'll never do more than 3 in a 5 consecutive day period. Now, if you're not familiar with weekly options, real quick, they are based on this concept that, they typically start on a Thursday to end the next Friday. So, but now more and more of these names have weekly options out multiple weeks. But now every Friday becomes an expiration. We don't want to hold them into expiration, but what we do is we say, you know what, if we were putting a trade on right now on a Tuesday, especially coming into tomorrow morning, Wednesday, I'm going to be likely looking into next Friday's weekly options expiration, which would be April the 12th. So, that's going to be the next few days where I'm focused on which expiration, and then the middle of next week, I'll roll it out again to the following Friday. So we usually buy them with about 7 to 10 days to go before expiration, but we can buy them with even about 4 or 5 sessions before expiration, but we tend to be out of those with still a couple of sessions left before we would get to a Friday expiration. Canada Goose, as I mentioned, was one that we just had a 90% gain on here this past week on the downside, but this is a bull example, and here's a case where this one was starting to pick up, and again, this tests well, so that's why we started trading it, because it's not a household name, but you know what, it's outerwear, it's a growth industry. And here's another case where you get your signal right here, right at the end of that bar, right as it crosses above that longer term moving average. And here's another case where when you get in, you've got to endure about a half day worth of sideways, even a little bit against you behavior. And notice that ADX is starting to go flatter, but not rolling over. And the next day, it's off to the races again. So you can see that it's the 3rd day in here, 2 days after that initial entry, is we get that spike down. And we don't get panicked by that per se. We just say, you know what? Okay, we made 56%. It's rolling over. As it turns out, it went on to even bigger gains. That's going to happen sometimes, and I don't care, because all I'm trading is what I call expectancy, which is playing the odds when the odds are my favor. If I don't have the odds in my favor, if that ADX is not supporting my weekly options accelerator trades, I'm done. I really don't care what happens after that. If I don't have an edge, I have no business playing that game. If you start doing that, you are gambling. You're not creating an investable edge anymore. We don't want to gamble. We want to make sure you always have that edge. So in this case, here's a downside example of Macy's. we're not going to catch the exact peak on anything. We're just trying to catch the sweet spot. And you can see with Macy's how leveraged these can be, because Macy's starts to trend here on the downside. The stock's about maybe 34 and 3/4 to 35 range, and you see we're buying a 35.5 put. We're paying, you can see, $1.56, and then it drops real quickly. And in this case, even as it starts coming back up and the ADX rolls over, we still manage to make 53% the next day. So the beauty of this is that we don't have to hit a home run to get great leverage, especially because Macy's is so cheaply priced that we're paying next to nothing in time premium. So you're really getting some tremendous leverage when you can, buy an option that costs, in this case, about 5% of the stock price. So that's the goal. Now, how do we get these trades out to you? We call out real-time trade alerts in your email box and to your smartphone. In this case, this was a past one that said, buy to open the NVIDIA March week 2. That was the March 8th expiration this past month, 150 calls at 9:30 or less. Now, I show this example because I didn't want to show you winners. I want to show you what happens if we have a loser. Because we deal with losers, and you must deal with losers in your trading game, or else you won't be in the game long term. You've got to know that you can get out quickly. So here's a case. We just barely got that signal on NVIDIA. NVIDIA calls right at the close of that bar, and you see right away we're on the wrong side. But we're waiting for this ADX rollover here, which you see then it happens to knock us out right in here. And we end up taking a 17.5% loss the same day. Okay, so that's very normal. If you can't handle that, you probably should not be trading weekly options and buying weekly options, because it's saying, you know what, you give it a chance, it's not doing what it's supposed to do, then you get out. And that's why we'll fire out a real-time alert to say, get out now, and make sure that you clean it up and move on. So when you don't have that edge anymore, you say, I'm done, I'm moving on. That's the name of the trading game, is maximize your edge when you're right, get rid of the trade as quickly as you can admit and acknowledge that you're wrong. Too many traders don't acknowledge they're wrong quickly enough, and then they take their profits way too quickly. So you want to flip that script and say, look, this is that same kind of thing we were just teaching you about, is that 80% of the results on the Pareto's principle will come from 20% of the factors. Okay, so it's like 20% of your actions drive 80% of your results. And an interesting thing, in our 2018 trades, we went back and looked at this. 19.5% accounted for over 100% of our profits. And does that mean, gee, that's just a terrible system? No, it means that 80-20 rule is working in overdrive. And what it means is that you must take every trade on the system, or else you risk the picking and choosers types will miss that big winning trade. And I get some subscribers that will say, oh, I got in better than you did on a trade. I'm like, I don't want you thinking like that, because if you're buying in on something that's not working, it's probably not going to be one of our best trades. The best trades are right very quickly, and you want to make sure you're on it too. And that's where that auto trading setup can be so good, to make sure you're not missing something. If you're an hour or two late, you're probably going to be too late a couple hours later with this system. You need to be on board quickly, and the faster the better. Okay, so check on that with us at our 800 Big Trends number if you're concerned about working a day job or being distracted playing golf or whatever else, that you want to make sure you're getting the benefits of that with an auto trade arrangement that won't cost you any more than what you pay for the trades yourself when you place the trades. Now here's the trade I just mentioned on Canada Goose from this past week. You see we got into this one actually on Friday the 22nd, and here's a great example. So you can see it was just kind of dead. It had a retracement. Obviously, it's in a negative moving average, so we can only take a bearish configuration on the ADX, right? So remember the bearish configuration, the red line is what? It's a negative directional movement. The new lows are starting to eclipse the new highs. And more importantly, the ADX is coming from a very low level here and just starting to cross up. It turns out that it crosses up, interestingly enough, not on the big red candle down, but actually on this green candle. So at the green candle's close at about 50 bucks, that's when we're buying the Canada Goose 53 strike puts. So think about that, a 53 put, right to sell at 53, it's already at 50, it's worth 300 bucks, you're paying 370. So again, somewhere in the neighborhood of just under 20% of your total premium that you pay is time of risk. So that means if it stayed dead flat into the expiration, you'd lose $70 out of your 370, and you retain 300. Now, obviously, you have price risk. If it's going too much against us, that can make your loss worse than that. That's why it's important to watch that ADX and make sure that it doesn't get you flipped to where you need to be out of the trade. Here's another case at second half of that day on Friday last week. Friday before last, I should say, the 22nd, that sideways consolidation, you say, oh, we're heading into a weekend. I think I'm just going to clean it up and move on. Well, you can see if you do that, you're cutting your profit in half or a little bit more than half. In this case, it plunged there on Monday morning on the 25th, last Monday. And then this is interesting because where is our double going to hit? A 53 put that we paid $370 for. Can anybody tell me what's a double on 370? It's a pretty easy one, right? $740. Okay, I'm testing to make sure you're still awake out there. What's $740 subtracted from $53? Well, you know, $7 would be down at 46. So we know 45.60 is where we should be getting a double just intrinsically. It actually traded like a penny under 45.60 right here on this rectangle. And we said, you know what? They did not fill us for some reason. Now, this is where the art of options trading kicks in more than the science of options trading. Our indicator still looks bearish, still looks like we should give it a shot to get our double. But we've learned that if you don't get filled when you should, and it was right there at your intrinsic value, that maybe the market maker knows something in that very short-term intraday order flow that we don't know. And so we said, you know what? Better, as the old saying goes, that bulls and bears get rich and pigs get slaughtered, right? Let's not be hoggish about this. Let's take the 91.8% gain, and we just went ahead and changed our order, said let's go ahead and be done with it. And we're glad we did, because then you saw what happened. It flipped up, and it would have hit our trailing stop and knocked about 30 percentage points off of that profit when it went from 45.5 to 47. So that's just those little nuances that I've learned in now almost 30 years of options trading that I think you're going to benefit from here with the Weekly Options Accelerator program. Now, how does Weekly Options Accelerator work? What's it about? We've got this catalyst of this momentum breakout driven thing. Sometimes they're based on earnings reasons or analyst upgrades or downgrades, or who knows what the other quote reasons are, but the price action is going to tell you that the configuration and structure is right for that really good trend move. We buy them in the money. This means you've got a quote high delta on your option, meaning that a lot of times our delta will be in the neighborhood of 80% or more, meaning stock goes up a point, we get 80% of that point in our option, and we're paying a lot less for that option than we would for the stock. Now, the ADX turns will definitely get us out of the trade, or our profit protection stops. Once we get over a 30% gain, we start sending gradually up your price stops to make sure that you don't get back too much of your gain. We will, though, ride as much as we can on that ADX until we get to the double. That's where we do cap it. A long time ago, I used to say, let's just let it run as long as we can let it run. But occasionally you walk in the next morning and there's some big market move, there's some Twitter storm from the president or whatever else, and all of a sudden you're reacting to a gap against you. We like to go ahead and take that bird in the hand, take that double and run. You get a weekly video training update every single week. I walk you through all 6 of these big names, all the positions updated, what I was seeing the prior week and what I'm seeing the week ahead. As I mentioned, if you came in late, $10,000 model portfolio would be up over 67% over the last year and a quarter, $6,700 in gross profits before commissions. And as I said, if you pay too much for commissions, check with us. We can help you get the brokers who can really get you not only good prices, but more importantly, quick executions. And that's where that auto trade can kick in as well, to allow you to make sure that you're participating in each trade. You just tell them how much you want to commit per trade. I'll get into that in a minute too. And like you see, the month to month, sure, there's going to be up months, there's going to be down months. I don't even mind if I've got half of those months down, as long as those down months are relatively small, and you can see they are on average, versus the up months being a lot bigger on average. That's our goal. Win big, lose small. That's all that it takes. Now, when you go to this page, and I'm going to check it out with you here in a second, bigtrends.com/WOA, short for our Weekly Options Accelerator. essentially what we've got for you is a great special. You can get 3 months at a time for $2.95 as part of this festival special, but frankly, the best special is over here on the right, which means that normally if you bought a year, um, I could essentially take some off of the year, take it down to $8.95. But what I'm giving you today is an instant double on your subscription term. I'm taking your 12-month access on a year, turning it instantly into a 24-month access. Buy 1 year, get the second year on me with my compliments, as this festival special will only last for a short period. That means that in 2 years, I'm going to assure you and guarantee you're going to get at least 200 trades from me over the next 2 years. If you break that down, that sounds like a lot. It is, but bottom line is that's 100 trades a year. That's about 8 trades a month, give or take. Could be sometimes 6 or 7 trades one month, could be 10 or 12 the next month. But on average, you'll get that 8 or 9 trades a month, gets you to a couple hundred trades, and that breaks you down to just under $4.50 a trade on this special. It's a one-time investment, $8.95. You lock in the instant double here, and all you do is you go to bigtrends.com/WOA, WOA, and they'll take you to this special page here that we've set up here for the festival to allow you to see, hey, 8 to 10 trades a month, and on those 6 names exclusively. I didn't mention this, the contract prices are averaging under $5 a contract. That means that on average, you could get a couple contracts on that $1,000 model portfolio, and that gives you, some nice bang for your buck versus trading the stock, and also knowing you're going to only be in for that window when you really need to be. As you scroll down that page, you see on the bottom right side, you got loads of examples of not just doubles, but other ones that we took quick profits on of late. And looking back, and you can see that when you hit the add to cart button, that's going to give you the best special, that BOGO, buy 1 year, get the second year on me. Or you can just click the text down below, and for just $2.95, you can try it for the next 3 months. The big thing is just to make sure you get started. If you're afraid of missing out, that's usually the number one objection that we hear, is people say, I just can't follow this stuff real time. Contact us, or once you subscribe, you can ask us, how do I get set up with TD Ameritrade or Auto Shares? Whether you have an account or not, they would be the ones that could help you get in and out automatically. You'd never lift a finger. You just tell them how much you want to commit per trade, and then every time we send a real-time email and text alert to you and to the auto brokers, you're getting an instant fill on as we get filled in, and more importantly, get filled out on all these trades. We never leave you hanging. You always know where you stand and when to get out on every trade. So when you click that add to cart button, then I'll wrap it up here in the next few seconds. Basically what you see here is that it instantly assumes you would rather have 2 years than 1, right? I think that's a pretty good economic assumption, right? Rational assumption. 2 years for less than the price of 1, actually. All you do is hit the green checkout button or the PayPal button and scroll down, get your key information in bold. And the reason I'm showing you this page is because I do want you to, Chris Sayre, my lead consultant's helped answer questions. If he's helped you or if I've helped you, however, doesn't put whatever's helped you there. But in this customer note field, if you want to get the text alerts in addition to the email alerts, you can say text the alerts to whatever your number is, and then tell us if that's AT&T, tell us if it's Sprint, tell us if it's Verizon, whatever it is. Put your text number in there, and that way you'll get the text alerts. No additional charge from us. Just make sure you have unlimited texting on your phone plan. Review the terms and conditions from bigtrends.com, and then click on this box. You're getting 2 years for less than the price of 1, $8.95. Gets you 200 trades plus over the next 2 years. Hit the green submit order button, and you're good to go. So with that, I want to say thank you. It's always a pleasure participating in the festival. If you have questions, here on the top right of that bigtrends.com/WOA order page, you can call us toll free at our 800 Big Trends line. If you can't remember that number there, just remember 800 Big Trends on your phone. That'll get you to us toll free, or email us anytime through clientcare@bigtrends.com.